Welcome to this video. We're going to discuss now money, growth, and inflation. This is chapter 30, Principles of Economics. Remember, this is a book of Gregory Mankiw, 8th edition. So then, first of all, we know that as a fact, everybody knows that the prices, they are not exactly the same for a length of time. Maybe one day to other time, to other day, 1 month compared with other month, maybe they're the same. But actually, some of them they change even daily. So what we call inflation is basically the increase of overall prices. This is the definition of inflation. Basically, as we saw previously, it is calculated with the percentage change in CPI, which is the Consumer Price Index, or there is another method, which is the GDP deflator that was seen in previous chapter in detail. So in the case for the United States, actually the United States has experienced on average an increase of 3.6% per year, and actually we can consider that as the prices they have been multiplied by 17 times during the last 80 years. Actually, we can consider some weird periods that the prices they decrease, the overall prices decreases, what we call deflation. However, this is not usual. There is other case for other countries that they have experienced hyperinflation. Hyperinflation is considered basically when the prices increase more than 50% per month. Actually, the most famous case is the situation in Africa for Zimbabwe, which actually they experience 24,000% in increase of prices. Actually, we're going to try to verify how the quantity theory explain how this phenomena occurs. And actually, we know that everybody dislikes this. When everybody talks about inflation, actually, we associate that as a bad thing. So we are going to take this topic throughout the classical theory of inflation, which the level of prices and the value of money. Actually, it was developed by the first economists. We are talking about 19th, the very beginning of 19th century. And actually, we know that, for example, for an ice cream, people they have been paying more. And actually, it's not for preferences. It's not because everybody likes more ice cream. This is just because the money with the time it is less valuable. If you had to pay like 80 years ago a couple of cents, today you need to pay $1, $1.50, $2 for the same ice cream. So actually, this is more related with the value of money than the value of goods. So it means that it doesn't imply that the ice cream now is like more expensive than before. So we know that the price level is like the price of the determined basket of goods and services, or how much you can purchase with a determined quantity of money. So we can consider that as a price level. So this is the key fact of this situation when we analyze money. So the level of prices can be considered with the CPI or the GDP deflator. Actually, we can define P as the number of dollars needed to buy a basket. Or we can make that the reciprocal, and then we have the 1 over P is the quantity of goods and services that can be bought with $1. Okay, So then this is the situation. If the level of prices is 1, so it means you can buy one for example, particular of this good with $1. Automatically, if you have P2, so the price is double compared with the 1, so just with $1 you can purchase half of this specific good or service. So then, the P is the price of goods and services measured in terms of money, and the 1 over P is the value of money measured in terms of goods and services. So let's talk about the ice cream. So if the ice cream is 2, the value of $1 is a half cone. So you need naturally $2 to have one. Imagine that now the price is 3. So now the value of $1 is a third cone. So actually in economy we have like a million of products. The idea remain exactly the same. So we know that the price of money is at any other good that we have reviewed before. So how is calculated the price of in a determined market? Well, the price is calculated by the forces of supply and demand. In preceding chapter, actually we had a look at how banking system and Fed determines the supply of money. So we know that when the Fed, which is the central bank, which has the authority, actually they make an open market operations. So actually, when they sell bonds, basically they receive dollars and they contract the money supply. If it is the opposite, that the Federal Reserve buys bonds, then they pay dollars in order to get these bonds, and then this money fall into the people hands. So then those dollars are deposited in a bank, and we know that the multiplier will act. So then we know that we take in this model that this demand supply is managed for the Federal Reserve. But actually the demand of money is a different story. Actually it depends on how much wealth people want to hold in liquid form. So many factors affect the quantity of people that they want to keep liquid. So if you want to keep this money in cash or you want to keep it in deposits in your bank. Actually, they could be some cases how much they rely on credit cards, how they work, how they are accepted. The more they are accepted and the better the credit card works, people prefer to use credit cards. But for example, if you had a credit card that maybe doesn't work properly, maybe sometimes it passes, other it doesn't. So definitely maybe this is not like so reliable. So you prefer liquid money, or maybe you know if an ATM is easy to find. So actually, when you go to another country, or maybe you go to the jungle or to some like really difficult place that you know that the ATM maybe it doesn't exist, actually you tend or you are tempted to have more money liquid, more in cash, right? So actually, we will keep here the idea like we will keep here that will be affected in this case just by the interest rate and by government bonds or low interest checking account. So when you have a higher interest rate, you are tempted to keep your money in your bank. Then you have less incentives to have this money liquid. So the idea is like we need to verify how it will be managed with the average level of prices in the economy. So naturally, the higher prices are, so you know that you need more money in typical transaction. So then the quantity of money demanded will be higher. So we are going to verify if it is like okay of it if it works for the short and the long run. Naturally, we need to differentiate these two periods. In long run, basically, the money supply and money demand are brought into equilibrium by the overall level of prices. So we now know that maybe in the long run the prices or the inflation will not I mean it's not going to be a key factor for determining actually the market of the money supply. So for example, let's have a look here to a graph. Actually, let's start with a price level above equilibrium. So it means people want to hold more money than the Federal Reserve has created. So then the price should fall until demand is equal to supply. Otherwise, the price level is below the equilibrium. People will like to hold less money than Fed has created. So then the price level should increase to balance money and supply. This is the case. Imagine we are here, we have the value of money measured by 1 over P. Keep in mind, it is like the higher is like your dollar is less valuable, the lower your dollar becomes more valuable. Okay, so here is the situation. So we have a price level which is going here, it increases above to the bottom, and here is the opposite how usually we have the variables. So we have here the 1 over 2. This is quantity fixed by the demand by the Fed, and this is the money supply. So then the situation is like, imagine like Fed prints some money. This is like purchasing bonds. So each dollar is less valuable now. So remember, every time that we have a change in Fed, it means that it changes the supply because they manage supply. So when there is an increase in the quantity of money in the market, we have this movement, this shift from money supply 1 to money supply 2. We started in the situation of A. Then we now have the equilibrium in point B. What happened here is like decreases the value of money. Your dollar become less valuable. And actually we have here an increase in the level of prices. So here we have, as a consequence of a money supply increase, we have an increase in the price levels. So now we're going to have a brief look at the adjustment process. Actually, we know that there is an excess of money, and when there is an excess of money, so when you receive more money from one day to another, then what are you going to do with that? Naturally, you're going to use at least one portion of that to buy goods and services. So imagine that actually they can put like more in the banks, so you can spend or you can put money into your bank, so you are going to generate more money because you know when you deposit, the multiplier start to work. So remember that the ability to supply goods and services has not changed. It remains equal. So the economy's output is determined by basic things: the available labor, which are basically the inputs that we have, the physical capital, human capital, natural resources, and technological. If it doesn't change at all, then the supply goods and services don't change. So here is the situation what happened actually in the short run. So people are using more money for transaction. Basically, the overall prices for goods and services adjust to bring money supply demand into balance. So this is the situation where demand displays or goes from A to B and is a movement of the money supply. So we're going to discuss now the theory behind this idea, which is the classical dichotomy and monetary neutrality. So we need to understand changes, so then we need to split variables in two. First, the nominal ones. So all of them, they are measured in monetary units, and the real ones, those are the variables measured in physical units. So, for example, income corn is measured in dollars. So then the income corn farmers is a nominal variable. But the quantity of corn produced is real money because this is measured in bushels in this case. So nominal GDP is a nominal variable. Real GDP is not. So this classical dichotomy, which actually was performed by the very beginners of group of economists, so they created this division of these two groups. Obviously, it's kind of tricky because imagine that the price of wheat and the price of corn, these are nominals. But what about relative prices? Well, when you talk about relative prices, it's a ratio. So when you have a ratio, for example, 2 bushels by is exactly the same of 1 bushel. I'm not sure if it's considering bushels as well, but 1 bushel in wheat. So naturally, the value of the first, the corn, is going to be valuable 2 times. So when you make these relative prices, the unitary money is cancelled. So then the relative prices we consider as a real variable. Real wage is a real one. So the classical dichotomy is very important because we differentiate the forces that influence real and nominal variables. And here is the key of this chapter. The nominal variables are influenced by changes in the monetary system, and then the money is largely irrelevant for explaining real variables. But this is just for the long run. This is a great conclusion. Money per se is not relevant for real economy in long run. So then, we know that the economy's production of goods and services actually it depends on labor, land, technology, factor supplies. And for example, we have now that the real interest balances the supply and demands for loanable funds. So then this is how we represented before. We didn't talk about prices. And when we analyze the market of labor, we talk about the real balance and the real wage balance, actually the supply and demand for labor. So this is the idea, because actually when there is a double quantity of money, the price level doubles, dollar wage doubles, and other values double. So then in this easy interpretation, we have that the money doesn't have any change in real variables. As production, as employment, and real wages and real interest rates, they remain unchanged. So is what we get this powerful conclusion. The irrelevance of money in real variables. It is called the monetary neutrality. So, however, the story is really different in the short run, because 1 or 2 years actually it can affect real variables. So it's something that we need to have or review in detail. So in order to continue to develop a little bit more this theory of the quantity of money, we are going to discuss about the velocity and the quantity of question. So the question here is, how many times a bill is used to pay goods and services? This is what we call variable of velocity of money. So here we have the price level. This one, this like kind of a Y. This is like quantity of output, the real GDP, and M, the quantity of money. So we say that the times that a bill is used to pay goods and services in 1 year is exactly equal as the level of prices times the quantity of output over the quantity of money. Maybe it's not like really easy to understand, But let's have a look with an economy that produces just one pizza. So when you have this pizza, imagine that the production, the quantity of output is 100 pizzas. Imagine that the price of one slice is exactly equal 10. Then we have now that the quantity of money is 50 in this like artificial economy. So we have that velocity is exactly equal to 10, which is the price level, times output 100 over 50. This is exactly equal to 20. So it means that people spend a total 1000. Why? Because you have the prices times the product, so people spend 1000. In order to spend 1000, each dollar must change hands 20 times per year because the quantity available is just 50. So this is the velocity of money for that specific economy. If we just put here this m, it goes to the other side to multiply, we have v times m equal p times y. So this is called the quantity equation. Basically, it shows the increase in the quantity of money. This must be reflected in one of other three variables. So if the quantity of money increases, what should happen? The price level must rise, the quantity of output must rise, or the velocity of money should fall. And actually, this is an interesting graph for the United States during the 60s to 2015. So here we have basically the quantity of money that we have here, the M2. Remember, this is the quantity of money. And here we have the nominal GDP. That, remember, this is the production of a specific years of final goods and services for a specific economy. And here this is value at current prices. This is not like value in a base year. So this is why this is a nominal variable. It increases and it decreases as well. So as you can see here, actually the velocity, it remains basically the same. It doesn't change too much, the velocity. So then, 5 conclusions for this classical theory of inflation. The velocity of money is relatively stable over time. We saw with an example. But because this velocity is stable, when central bank makes a change in quantity of money, which is m, it causes proportionate changes in the nominal value of output, which is p times y, which is the definition of the nominal GDP. Y is determined by factor supply. So then money is neutral. It doesn't affect the quantity of money. Fourth, when the central bank alters the quantity of money, what happens as a consequence? There is a change in the prices. And basically the conclusion is increase of money supply increases the level of prices. Here is some specific situation. This is so interesting because it's different economies. I mean, economics is not like easy to make some practical experiments. You cannot like just put a lot of money in one country to verify what happened. It's not as easy as that. The laboratory actually for economics is the real life. And this is real life for different countries that they experienced hyperinflations. We have Austria, Hungary, Germany, and Poland. And what is the common situation here? Basically, the similar situation of quantity of money and price levels. The more money you create, the more price level you have. Then, we are going to consider now how inflation could be kind of a tax. Well, basically, the government can use the print of money to pay their spending. Obviously, as they don't produce anything, actually, the idea is like there is more money in the economy, and basically, at the end of the day, the prices can increase. So, actually, in other conditions with taxes, you can maybe just like charge taxes to population so they can be used to pay what they have to pay. Actually, when you have more money in the economy, your money is less valuable. And basically, the inflation can be considered as a tax to everyone that has money. So this why the inflation tax could be considered inflation like a tax. It's the same consequence. Now we're going to experience or we're going to talk about the Fisher effect. The Fisher effect is based on the increase of the rate of money. Basically, it takes the dichotomy or the classical dichotomy that he says that it doesn't affect real variables. So actually, there is a link in the economy of the present and the economy of the future through changes in saving and investments, which is actually the interest real rate. So we have one side which is the nominal interest rate. This is the one that we see at banks, and it's actually the one that you can find everywhere because they don't take into account the inflation. And it's natural because if you are for example asking for a car loan, they're going to provide an interest rate, and you're lucky if in the future the inflation is over this value, right? So for example, your inflation is 12% and your debt is 10%. Take into account that your salary will increase 12%. So this is a great deal. Actually, you are paying -2 of the interest rate. So because we don't know what is going to happen in the future, people present naturally entities, different entities, they present nominal interest rate. But the real one is the one that we discount the effect on inflation. And actually it's the really that we really want, the really that is relevant. So the equation will be the real interest rate is exactly equal to the nominal interest rate minus inflation rate. Imagine an example. We have a nominal interest rate of 7%, our inflation rate of 3%, and then the real interest rate is 4%. So then we have this one, the real interest rate exactly equal to this. So it basically you have here, if you increase money supply, in theory, this should not affect the real interest because if it's go up, but it goes up one by one, this one should remain exactly the same. So then this is what we call the Fisher effect. The change in inflation 1, the nominal interest rate change 1, the real interest rate should not change. So again, this is a long run perspective, but in short run we cannot consider as that. This is a situation how we say that in the real life it happens. We have again here the US and we have the relationship between nominal interest rate and inflation. As you can see, they move basically together. So this gap between these two, this is the real interest rate. The higher the gap, the higher the interest real rate. Okay? Then we are going to discuss now the different costs of inflation. It means why inflation we don't like it. And the conclusion is basically when we have an inflation lower 10%, it doesn't affect too much. When it goes up 10%, when prices need to change more often, this is actually when we suffer a lot. For this case, maybe this is not really easy to understand people who live in United States. People who live in Venezuela right now, they understand very well this situation of inflation. People that they live in Argentina, they know as well. Okay? So then, actually, inflation is like really is one of the most important macroeconomic variables that it is seen like in newspaper every single time. So if we talk to average person that they don't know too much about money, naturally this person will say that they don't like that his or her money value less. But imagine the situation that the prices increases, but in the same case your salary increase. So then it's what we call the inflation fallacy. Because maybe inflation is not bad or it cannot be really bad if all other variables they change in the same percentage. So then inflation fallacy could be that situation. Other important costs of the inflation is the shoes leather. So what does it mean? Basically, it's like kind of we know that inflation is similar or can be considered as a tax. We saw in the first chapters that when we have a tax, the resources they are not allocated properly. Due to they are not allocated properly and transactions are lost, we provide a dead weight loss. Remember that this dead weight loss is the part that is not taken anymore by the consumer, neither the producer, right? So these produce a deadweight loss. So people, when you have this one, that your money is less valuable day by day, you try to keep less money in cash because at least in the deposit they produce some interest, so they go. If we consider the Fisher effect, they will move exactly with the same of inflation. Or if the situation is really extreme, maybe you don't use your money as a store of value, so you start to buy food or you start to buy money, I mean foreign money, foreign currency, which is dollars, for example. So you go more to your bank because you need more cash, I mean more times cash, because you don't want to spend or to have too much money in cash. So you can imagine that is paradox, but your shows wear out more quickly. Obviously, this is not the real cost. The shoe leather is just the name. Basically, this is a real cost for your time, to your convenience. Imagine the situation that you have the money and you need to go different times to the ATM because you know that your money will get less valuable day by day. So this is the shoe leather. Other cost inflation is what we call the menu cost. So we know that most firms basically they don't change the prices every day. They keep the prices maybe for a period of 1 year, more or less. So these cost price adjustment are called menu costs because imagine the situation that you have your restaurant and every single day you need to print a new menu. This is anyway, it's not convenient. You need to get more of your budget in this situation. So, and it's just not that, but you need that. You have a cost of deciding new prices. You have a cost of printing new price catalogs. You need to send these new prices, lists, and catalogs to dealers and customers. You need to advertise with new prices. So this is overall the menu cost. Other cost that maybe is kind of difficult to understand is the relative price variability of misallocation of resources. So when there is an inflation and just one firm adjusts price 1 year, the relative price of this product will change compared with other prices or other goods that they are changing every single day. So this is the case when the relative prices are changing, when other ones they cannot change. So there is again a misallocation of resources because you are valuing your money because of the relative price of the comparison of this good compared with other goods, and that's not true because the other ones they are not moving. So this is like problem of misallocating resources. And the inflation induced tax distortions. Why? Because inflation basically can discourage savings. For example, if you have a situation of one tax that if you gain, if you earn $100 for a capital, and then you need to pay a tax for that. You pay a tax for that, but actually imagine an inflation so high. So then actually the real money that you are earning, this is not 100, but you are being charged because of that. This is a situation of two economies. One with price stability, it means 0% inflation rate. And you have another one with 8% of the inflation rate. They have exactly the same. The real interest rate is exactly the same, it's equal to 4. But then we are going to develop or break down these changes. The nominal interest rate is 4 and the nominal interest rate for economy B with inflation is 12. Then we have the reduced interest due to we have a 25% tax. So this is going to be charged to the nominal interest rate as usual tax system is created. So then we have 0.25 times 4. We end up with $1 and we end up here with $3. Then after the tax of nominal interest rate, so we have the 75% of the nominal interest rate. So the economy A will have 3% and the economy B will have 9%. Then what should be the interest rate after tax, the real one? So after the tax nominal interest rate minus the inflation rate should be 3 minus 0, which is the inflation rate, so we end up with a real interest rate of 3. Other situation, if the economy B, because they have a 1, which is exactly 9, minus 8, so you see here the difference. When you charge in your nominal rate, your effect should be worse for the situation of country with inflation. So then it can be solved if a tax law is rewritten taking into account inflation. However, you know that at this time the tax law is really difficult. Imagine if you increase with inflation, it gets even more complicated. But anyway, some changes have been registered in order to avoid these problems with inflation when we have tax distortion. And the last one is the confusion and inconvenience. Because actually, people make some projects, some ideas, thinking about the target inflation that the central bank provides every single year. And when it changes different from that value that people say, so people get more confused. So people cannot adjust easy as before. For example, just like when you have the earning firms that they represent your income statement, maybe you don't know if this changes to prices or if it's because of a more quantity. So it's more difficult to understand because actually maybe just the nominal variable they have changed, but not the real ones. And now this is, I guess that now this is the last cost of inflation, which is a special cost of unexpected inflation, because there are like arbitrary distribution of wealth. Well, basically, when you have an expected increase, you allocate resources in different way. As simple as you have a credit and you have a constant interest rate, if it's lower than inflation, this is definitely a great deal. It is higher inflation is tend to be more uh, more unstable. Before going to this, first the situation here is like if you cross your fingers and the inflation is so high and you're paying lower than the inflation, this is a great deal. Other the case that you have the other situation that you need to pay a higher interest rate compared with the inflation. And it is considered that when we have countries with higher inflation, they fluctuate more. So when we have double digits, those countries they have a higher fluctuation. So we have this more uncertainty. And then I guess that now this is the last one, the cost of inflation. Inflation is bad, but deflation can be worse. Because actually Milton Friedman, outstanding economist, suggests like nominal interest should be like kind of close to zero. It means that inflation should be negative because remember again this one that the real interest rate plus inflation rate is equal to nominal interest rate. So if nominal interest rate is so close to zero and then this interest rate is higher than the nominal interest rate, then the inflation should be negative. So there are as well many costs and changes in relative prices when we have deflation because you need to change the prices and the relative price changes as well. And actually this is really painful for debtors because they need to pay more than it was expected. And actually this deflation is symptom of major issues that it goes basically with unemployment and basically a decrease in the GDP, the real one. And then a special cause of unexpected inflation. Arbitrary, I guess that never is going to be the last, but whatever. The arbitrary redistributions of wealth. So then, an unexpected increase, so allocates different way. So this, well, actually was like kind of repeated. And the conclusion. We talked about the causes and the costs of inflation. Why this inflation, we have these problems in the short run. And then the first cause is the quantity of money. More money, it means more inflation. And then we know that the short run, this neutrality of money is not so clear. This is more for the long run. Okay, hope it has worked. You have understood better the importance of inflation, the cost that we have, and go and find out different cases of inflation, hyperinflation, and you will find something really, really, really interesting. Okay, thank you again for watching these videos, and more than that, hopefully it has been relevant for your studies. Bye bye.